Hi, everyone. I'm Ken Leon, Director of Equity Research at CFRA, and welcome today to our webinar, Playing Defense in a Volatile Market. With me today are Colin Scarola, Vice President Equity Research, and David Holt, Senior Analyst Equity Research, to cover government and defense outlook. Next slide, please. So our agenda, I will go through about CFRA, and then we'll get to our theme, which is related to the defense industry trends, spending outlook, as well as moving to the federal IT services. Colin will do the first part on defense. David will cover federal IT services. We think this is an interesting topic because we're not totally correlated to a cyclical US economy and the pandemic. Next slide, please. For those who have not seen this slide before, it's an introduction to CFRA, 90 years of innovation and growth through two leading franchises that are now one as of 2016. CFRA has a world-class reputation in forensic accounting. It acquired S&P Equity and Fund Research back in October 2016, and we have expanded dramatically, acquiring First Bridge data for ETF. So today, CFRA is one of the largest independent research firms. Moving now to slide 5, you can see the kind of flywheel of our capability of driving research with a proprietary methodology. It's a blend of really two strong areas for the firm: fundamental equity research and forensic accounting research as well. The teams in total professionals, over 75. We distill through MarketScope Advisor, our platform, for subscribers, market commentary and sector research from Sam Stovall, our Chief Investment Strategist. We have ETF and mutual fund research led by that team with Todd Rosenbluth. And then our analysts are doing the industry and company research and often are doing not only the deep analytics, but coming out with very timely thematic research on MarketScope Advisor. We also are well known for our model portfolios, and our forensic team is always coming up with very interesting investigative insights. Next slide, please. I can't emphasize this enough about research serving investors, that CFRA is 100% independent. All of our resources go to one area, which is research. Our opportunity is to be more agile, to be more innovative, and to provide to you the best research that we can. We do not manage money, nor do we make trades. We're not a broker-dealer, and we don't have asset management firm. Other firms may claim to be independent, but they're not. We certainly are, and we're delighted to have you today. Next slide, please. So with that, let me turn it over to Colin to go through today's program. Good morning, Colin.
Good morning, everyone, and thank you, Ken, for the introduction. So we're going to start with a quick overview of what David and I will be talking about today. So on page 8 here, the general theme we want to discuss is looking at the largest companies in the S&P 500 who focus on defense and government contracting work. So what we have in this chart is we're comparing the year-to-date performance of the S&P 500 index to S&P 500 companies that generate 75% or more of their revenue from this government contracting work. So what's been standing out to us is that the defense and government stocks have performed very much in line with the broader market. So that's kind of implying to us the market thinks these companies have similar outlook and earnings trends, similar risks to the broader economy. And so the spoiler alert here is that we don't think that's the case, and we're seeing some good opportunities in these industries. So let's go to page 9. And we'll start with a recent history of U.S. defense spending trends. So the first thing we want to talk about here on page 10 is that these defense and government businesses, they're not correlated to the broader economy. So if we go down to this table here, the cells we've highlighted in yellow are the defense and government firms' cumulative revenue and earnings growth through the past 2 U.S. recessions. So you can see in all cases, these defense and government firms had very strongly positive revenue growth and earnings growth through the recession and recovery years in our past 2 recessions. Now you can contrast that with the S&P 500, which has generally been negative or sometimes flat through these periods. So that's indicating to us that these businesses in defense and government contracting, they're really not correlated to what's going on in the broader economy. So let's move on to page 11. So let's think about how the defense spending driver relates to recessions, and whether or not it really does. So what we're looking at in this chart, the bar chart on page 11 here, is the annual percentage change in U.S. defense spending. And we're calling out recession years for the U.S. economy with gray bars. So an important thing to note here is that each time you see a gray bar or a recession, you don't necessarily get a decrease in defense spending. So we note there's been 3 periods circled in red here where defense spending was substantially decreased, and those have not always come right after a recession. So you can notice 3 recessions in the 70s and 80s, no defense cuts followed those. You had the recession in 2001, no defense cuts followed that. And then there were defense cuts in the 2012 to 2015 period, but those had a pretty good gap of about 4 years from the 2008-2009 recession. So that's what we want to call out here, is that the defense spending cuts don't seem correlated to recessions. So let's go to page 12 now. So what about federal deficits? Because that's something you hear a lot in the news, that as the government runs up greater and greater deficits, eventually it's going to mean that spending cuts will have to flow through to defense. Well, we're tracking on this chart here on page 12, the federal deficit as a percent of GDP with this orange line. And one thing that's pretty notable here is large deficits are essentially the norm for the U.S. economy and the U.S. government. So specifically, if you look at the early 80s period, you had a very big surge in deficits then, and really no cuts to defense spending occurred in that period. You also had, again, around 2002, a big surge in the federal deficit, and no defense spending cuts followed that. And again, a very large surge in the federal deficit around 2009. And while defense spending cuts did eventually come, it was several years down the road. So we don't think it was necessarily tied to that federal deficit level. So let's go on to page 13. So this all leads us to the question, okay, if not the recessions or the federal deficits, what really does cause defense spending to decline? So we're looking at these same 3 periods with the red circles on this chart when defense spending reduction did occur. But now we're putting on here labels what we think really caused that. So in the early 70s, defense spending drawdown, that coincided with major operation and troop reductions in Vietnam. Then if you go to the mid-90s, the first Gulf War ended, and we also had the collapse of the Soviet Union ending the Cold War. And then more recently, 2012 to 2015, we had our Iraq and Afghanistan operations experiencing major drawdowns. So we think those aren't coincidences. We think that's what's really the driver of reducing defense spending for the U.S. It's not what's going on with the broader economy. It's not the federal deficit or debt levels. It really has to do with military engagements. That's what we're taking away from this historical analysis. Okay, so let's go to page 14. So let's let's talk about one more item that you hear as a potential risk in the future for defense spending, and that's the 2020 election. Because you often hear that a major Democratic victory in the presidency and potentially taking both chambers of Congress would be bad news for defense contractors. But in each of those past 3 periods that we marked out as the drawdown in defense spendings, the 70s, the mid-90s, and then 2012 to 2015, it's pretty apparent that those were bipartisan results. So you had a Republican president doing it in the 70s, then Democratic presidents in the latter 2 drawdowns. But in all the cases, you had these presidents working with opposition majorities, generally in at least one chamber of Congress. So to us, that's starting to look like this isn't necessarily a party priority. It's generally happening under bipartisan scenarios in Congress. So another thing that we think kind of debunks this risk is looking at a recent scenario in 2008 when we had an election year with a major recession going on, and we had Democratic victories in the presidency and taking full control of Congress. So that's very similar to the risk that we're hearing a lot about right now. Major recession year and Democratic victories in the presidency and Congress. But let's look at this chart and see what actually happened to defense spending following that 2008 election. So the first year when a new president comes in, the defense budget is already sort of set by the prior president and Congress. So even though defense spending did grow in 2009, that doesn't necessarily reflect the priorities of the new administration. But if you get out to 2010 and 2011, those were years where Democrats fully controlled the budget through Congress and the presidency. And we didn't see cuts in those years. So we had a recession and a recovery. You can see the orange line. We had a major surge in the federal deficit level, and Democrats took control of the government, and there was not a cut in defense spending. So to us, this sort of, it doesn't necessarily eliminate the risk of defense spending cuts, but we think it's certainly not, it's not the huge risk that people think it is, because usually these defense spending cuts aren't easily enacted by one party coming in. So let's go to page 15. So now that we've had a bit of a primer on the historical trends, let's talk about our outlook for the next 5 years or so. So we've set up sort of a scenario analysis with some probability weightings of things that we think could happen in the next 5 years to the defense budgets. So a key point to remember is that last fall, the President and Congress already enacted a law that sort of holds the budget flat through the 2020 election and through fiscal year 2021. So there's not really a major risk of cuts this year or next year. And looking out further, we think we are in a recession. We've certainly had very unprecedented spending levels this year. So we have a pretty low probability on an upside scenario. So we don't see a high chance of robust growth in defense spending. We think the most likely outcome is a pretty flat budget trajectory, maybe low single-digit increases, but generally a flat trend with no cuts. And certainly there is a downside scenario, but we think it's a lower probability, around 20%, that you'd see significant cuts in defense spending. So let's go to page 17. So we kind of laid out our probability scenarios, and on this chart, we're also showing you what the Congressional Budget Office defense spending growth forecast is. So here their forecast is for roughly 2 to 3% growth in actual defense spending over the next 5 years. So a question that might be on some of your minds here is, we've kind of put our highest probability on a roughly flat budget in the low growth scenario. So you might be wondering, how do you get to 2 to 3% growth in a flat budget scenario? So the answer to that is that this chart is showing the actual defense spending growth, which can differ slightly from the actual budget level. So just a quick aside on that. As an example, in 2020, we're going to see, based on the forecasts of CBO, we're seeing about 5% growth in actual defense spending, but we're still coming in 5% below the budget forecast, or what the budgeted amount is. So it's basically the difference between what are you allowed to spend under law versus what are you actually spending in cash. So there is some wiggle room around the budget levels. You know, if you came in spending lower than the budget level in previous years, you can overshoot the budget in future years. So that's generally how we're getting to this 2 to 3% growth forecast, even in a flat budget scenario. And the key point here is we think this is a pretty good outlook considering the high uncertainty and sort of the downward earnings trend we're seeing for the broader economy. So we consider this a pretty benign environment, which is a good thing during a recession in our view. So with that, we'll go to page 18. So now let's move into specifically the companies that operate in this defense industry and talk about opportunities here. So next slide, please. So just to highlight on some of the things we're going to touch on here is we've talked about defense spending not being correlated to the economy. So we think that's a good thing, that a key driver for these companies is not necessarily heading down with the rest of the economy due to the pandemic recession. We also don't see the same risk from an election year that we think the broader market is pricing in, which is creating opportunity. And something we haven't touched on yet, but we will, is that even in a scenario where defense spending does decline, we think that the major defense contractors are able to continue growing earnings even through that downside scenario. And we'll talk more about that later. So all of this adds up to defense stocks having a positive earning outlook in our view, while the S&P 500 has a flat or negative outlook. And you can get these stocks at a pretty sizable discount to historical valuation, whereas you'd be paying a premium right now for the index. So let's go to slide 20 and we'll dig into these a little more. So what we're looking at here is the major defense stocks only now. These are Lockheed Martin, Northrop Grumman, General Dynamics, L3 Harris, and Huntington Ingalls. All generate at least 75% of their revenue from defense and government contracting. And in the case of the bigger ones like Lockheed and Northrop, it's north of 95%. So they are very much pure play defense companies. And we can see through May, they've traded essentially the exact same amount year to date as the S&P 500. So that's what the market is kind of pricing for their risks and their earnings outlook. But let's talk about what's actually happening to their earnings on page 21, please. So what we want to call out here is the first highlighted cell in yellow in this table. This is the cumulative growth forecast for these major defense stocks through 2021. So 14% growth versus 2019. And that is the sell side consensus, which we're mostly in line with. Not a material difference there, with the exception of one or two companies. But compare that to the S&P 500. That's cumulative growth forecast of -1% over that same 2-year period. So what's going on here is a lot of companies in the S&P 500 they're pulling their earnings guidance. Many are seeing sizable negative impacts from the pandemic, and they're going to see lingering effects from higher unemployment. Meanwhile, most of these defense companies have maintained positive earnings growth guidance for 2020. So in our view, that's a pretty big signal that these companies that are maintaining growth through the recession and are lower risk, in our opinion, they shouldn't be trading down the same way that the S&P 500 has this year. And so if you move out to the right edge of this table, you'll see the premium or discount that these companies are trading at versus their 5-year average. So you can get these defense stock companies with a strong growth forecast at a 15% discount to historical valuation, whereas you'd be paying a 15% premium for the broader index. So we think that's a pretty powerful discrepancy. Let's go to page 22 now. So as we touched on a little bit previously, it's no sure thing that defense spending continues to increase. We know it has declined in the past. So let's think about what could happen to defense contractor earnings if we do unexpectedly see a sizable decrease in defense spending in the next 5 years or so. Let's go to page 23. So we know that there was a period of defense spending reduction recently. 2012 to 2015, some of you will remember, there was the sequestration bills and sizable cuts came through to defense spending. So it decreased 4% annually over this 4-year period. But what actually happened to the defense stocks during that period? So we're showing them here with this blue line on the chart. And it's a pretty obvious result. Somehow, even with defense spending declining 4% annually, the defense contractors materially outperform the broader index. So obviously this raises a question, how does that happen if the key driver, defense spending, is declining? So let's go to page 24. So an important thing to know about total defense spending levels is roughly 60% is related to personnel and operations, and around 35% is procurement of materials, equipment, weapons, and also research and development programs. So this latter 35% is really where the defense contractors are focused. So what that means is, in our opinion, you can have cuts to the total defense spending level while the chunk that the defense contractors are focusing on is actually still seeing a pretty healthy trend. So one example of this that we're showing on this chart here on page 24 is we're comparing the defense spending levels over that 4-year reduction period versus the F-35 Joint Strike Fighter deliveries that Lockheed Martin leads. So this is a pretty clear discrepancy. We had US defense spending in decline significantly over the period, and yet Lockheed Martin delivered 50% more jets by 2015 than it was in 2012. So this is an important note. High priority programs can keep seeing increases in funding, even if the broader defense budget is in decline. So we can go to page 25 now and we can look at some more examples of this. So it's not just fighter jets that are high priority. The Pentagon also has a high priority on naval superiority and things like drones, satellites, surveillance technology, missile defense. We think these are all areas that, even if we do see a general decline in defense spending levels, these are areas the defense contractors are highly involved in and that could still see increased funding. And another example we'll call out here is the electric boat company's revenues during 2012 to 2015. So this is a subsidiary of General Dynamics, and they are the lead contractor for our Navy's nuclear submarine capabilities. So we can see a very similar trend to F-35s. This is something the government, the Pentagon cares a lot about, and they're very focused on long-term superiority in this area. So electric boat continued to see substantial revenue growth from 2012 to 2015, even as total defense spending was in a significant decline over the period. So we think that's a pretty powerful relationship that is sort of overlooked by the market right now. Even if we do see spending declines, we think these high priority programs are pretty safe bets to continue growing, and that will allow defense contractors to continue delivering earnings growth, even if we do see defense spending cuts. So let's go to page 26 now. So sort of continue on this point, the ability to continue growing earnings through a downside scenario. What we're looking at on this chart is the backlog of these 5 major defense contractors. So the thing to know about these defense contracts is they're long-term in nature, and so it gives pretty high visibility into these companies' revenues a few years down the road. So if you look at the commentary and the SEC filings for most of these defense contractors, at the end of 2019, they had, there's no guarantees, but they had virtual certainty of about 85% of the revenue they'd be seeing in 2020. So because they had these contracts in their backlog that are set to continue rolling in throughout the year. And if you compare that to other aspects of the economy, the most extreme cases would be, say, movie theaters or airlines. Their revenues virtually disappeared in this highly uncertain pandemic recession. And you contrast that with these defense companies where they're actually seeing revenue grow in most cases. And even in the worst case, they don't think it would ever drop below 85%. So that's what these backlogs deliver. It's very powerful downside risk protection in our view. And just to give you one example, if we look at the chart, the biggest defense contractor, Lockheed Martin, they have more than double their annual revenue in backlog. So that gives them a pretty solid base going forward to work off of, even if things get really bad for the broader economy. So let's go to page 27 now. And we're just gonna recap this list of things that we think are all combining to present some strong opportunities in the defense industry. So again, we don't think the defense spending driver is correlated to the economy. We've done some historical data analysis on that, and it's shown no statistical correlation to GDP growth, federal deficit levels, or the political parties in power. We've also dug a little deeper into past periods of spending declines and found that defense contractors can actually continue growing earnings even when the broader defense budget is in decline, because they have high exposure to very high priority programs for the Pentagon. So you compare these things of no correlation to the broader economy in a recession and the ability to grow earnings even in a downside scenario. You compare that to the market and you'd probably be thinking, these look like pretty good earning outlooks. At least we think they are. So these companies ought to be trading at a higher PE ratio than the S&P 500. But the reality is they're at a 15% discount and the S&P 500 is at a premium. So our expectation is that over the next year or so, the market will realize that the earnings potential of these companies is a lot stronger than the broader economy, particularly in a recession. So we expect that valuation discrepancy to close, and it's going to deliver, we expect, some very promising returns for defense stocks. So if we go to page 28 now, we'll talk about our top picks in the defense industry. So probably no surprise here, some of these companies we've been talking about. Lockheed Martin is on the list as a strong buy for us. This is the lead contractor on some very high priority programs for the government in a few diverse areas, but the most notable program is probably the F-35, and that's expected to continue growing over the next few years. So we think this company's at least a 15% discount to its forward PE average, and it's got a very healthy earnings growth outlook. They actually maintained their earnings guidance after the last Q1 earnings release, which was in stark contrast to most S&P 500 companies who completely pulled guidance because they really don't know what's going on or what the outlook is for their revenue base. Another top pick of ours is Northrop Grumman, similar to Lockheed Martin, a strongly diversified defense firm. We think this one's trading at an even larger discount, so another attractive opportunity. And also General Dynamics is a third top pick of ours. This one has a slight unique aspect versus Lockheed and Northrop because General Dynamics is not purely a defense contractor. They've got about 25% of their revenue coming from Gulfstream business jets, which is in the private sector. It's not defense contracting, obviously. And so there's been a lot of fears around what's the outlook for air travel demand going forward during and after the pandemic. But we've done some analysis on this, and we think basically General Dynamics sold off very similar to commercial aerospace companies that supply airlines. But we think that the customer base for for business jets is much more safe and much more diversified than airlines. So we think this sell-off was very overdone, and we also like the positive earnings trend coming from the less risky defense side of General Dynamics. So they're another strong buy for us. So that, I believe, concludes our defense opportunity section. And with that, I will hand it over to David Holt to talk about federal IT services.
Hey, thanks, Colin. With the top level defense budget here and hardware outlook taken care of, I thought it might be good to switch gears and go over some names that are tied to government agencies, but under the IT services industry umbrella. So most, if not all of these names in this group have some sort of tilt towards professional services and technology solutions for the big three, with the Department of Defense, Fed, civilian, or intelligence agencies. But a lot of these names are also lower profile given their size or origination, but in our view, are often an overlooked area that have been solid value creators over the past years, as Colin has already touched on. They do hold a lower correlation to market cycles. So now I'm on slide 30. So here we are in 2020, and we're looking at a few different potential outcomes related to top level budget spending, but directionally and regardless of those potential outcomes, we think one thing is actually for certain, and that's technological advancement needs to happen to keep our country safe. So on this slide, we have what I would call some noteworthy stats of where we are now and where we could be going in the future. So if I were to assign baseball terms to where we are currently, I would say that we haven't even approached the 7th inning stretch yet. So updates still need to happen, especially with 70% of our national and military spending now being consumed by digitized work. So the other stat that really pops out here, looking at the slide, is that 64% of our infrastructure across the federal IT landscape still needs to be refreshed today. So to me, this is a leading indicator of how I really try to sort out specific companies that have the technical capabilities to thrive and really capture business in this scenario. So moving here to slide 31 with the push for IT modernization, it really encompasses a wide range of products and services that have really kept contract activity elevated here. So if I had to pick one key catalyst that was driving that large step change in priorities and strategies, it would be the general concerns around cybersecurity, which consequently has pushed up spending in most other verticals in the process. So that includes everything from cloud, analytics, and cognition at nearly every agency. So another prior issue that's really been a sticking point in the past is around shared services and data across multi-cloud environments. But newer policies that have been put in place, such as the Trusted Internet Connection or TIC policy, has really sped up that process and allowed for quicker uptake at agencies to house data both on-premise with servers and on public clouds. So other government strategies such as FITARA, or the Federal Information Technology Acquisition, and the Technology Modernization Fund have really put agencies on an accelerated path for IT updates in the future. So spending has seen steady increases from 100 million in fiscal 18 to where we are currently at 150 million for fiscal 20. So now we're on slide 32. I mean, here I really just wanted to give you a few ways to look at overall IT spending across government agencies. So the big key takeaway in the blue box, which is regardless of how you look at it and how you want to split it, the IT spending budget is expanding across all verticals longer term. So Here, whether you look at it from key government, defense, civil agencies, or that's on the left side of the chart, or from an IT aspect with software, hardware, or services, spending is expected to expand by about 2.5% CAGR through fiscal 2024. We think this really exemplifies the notion that IT budgets should hold up well, regardless of whether we see any near-term distractions with the presidential election or flattening overall budgets in the interim. So on slide 33, we have a snapshot of some of the main players in the space sorted by market cap. So as you can see, and what I referred to earlier, this is a concentrated group of pure play government IT companies. Another interesting point though, is the origin of these companies vary and range from firms like Booz Allen, who have been real pioneers in the consultancy space and actually started in private markets. And eventually transitioned and found their way with government IT services. And that's in contrast to other peers like SAIC, who actually spun off of Leidos in 2013. In our opinion, is just now hitting their stride and seeing success in the space. So moving to slide 34, here we lay out each company and industry expertise in a matrix across all the peers. So one of the highlights that is really important to take into account here is around technical capabilities, whether it be core IT, cyber, or digitized modernization. It's really the determining factor that positions some of these companies well to not only win new business, but allows the companies to exhibit discipline and go after the right kind of business. So when assessing those core capabilities across some of these companies, which are the first four columns on this slide, we think CACI, Mantech, and Booz Allen are in prime positions. So second, when we assess the latter half of the columns, from this perspective, we think one standout stands above the rest, which is Leidos, given their presence in all three markets, whether it be on the tech side or healthcare and civil markets. And they actually acquired some entry into those markets through their acquisition with Lockheed in late 2016, that quite frankly, we don't really think any other firm in the industry has right now. Going forward, size and scale will matter more in our view, given the correct balance of capabilities really help navigate through full defense market cycles, and especially with the move to much chunkier and longer duration contracts, it could put some of these smaller companies at disadvantages going forward. So transitioning now to slide 35 with a closer look at forward indicators across the space. So no doubt over the past, I would say 2 to 3 years, budget trends have worked in favor for most companies. That's led to backlog expansion following the last drawdown that was riddled what you would refer to as shorter cycle LPTA work, or low price, technically acceptable work, which was really just put in place to keep some peers in disadvantaged positions alive, quite frankly. So you fast forward to today, many companies have made the proper adjustments to win enough awards to drive, say, mid to high single digit organic revenue growth going forward. And the two key data points that we think investors should focus on is the booked backlog that already has the funding in place, which resides around 20% or higher, in some cases, for leaders in the space, which you can see in the chart in orange. And secondly, around total submitted bids outstanding. So that's in the gray bars. Assuming those standouts continue to win, say half of the proposals they submit, you can kind of back into how revenue profiles unfold in future years. And alluding to that notion, and despite some of the uncertainty related to COVID, most of these companies, as of right now, still have 75% or greater visibility to their full year outlooks. So moving to slide 36, we try to illustrate the cause and effect of margin and profitability dynamics across firms. On the left portion of the slide, you have the inputs with contract performance and how we think companies set themselves apart. And on the right, the output with how margins have really progressed over the past 4 years from fiscal 2016 to fiscal 2019. So, for example, with wrap rates, or the actual price charged to government services for services, which that's actually correlated to win rates, hovers around 50% on new businesses and 80% plus or higher on recompete of existing business for companies that are leaders in the space. So when you link that commentary around win rates with the slide prior around submitted bids, it's really easier to get a clean look of how organic growth and margins coupled together land for each company. So on the right portion of the slide, you can see which companies have made the most progress around margins with Leidos and Mantech. But going forward, we've called out companies that we think have the most margin upside in green with CACI and SAIC, which we'll cover later with stock picks in different slides. So moving to slide 37, I really like the quote on the left here, which I think holds truth more so in today's market with crises do not necessarily create new trends, but accelerate existing ones. And I think that's a crucial call out here for all these companies under coverage who have adapted well and kept their full year outlooks in place, which has been a rarity lately. And we really think underscores the durability of their business models that the companies possess. So on the right portion of the slide with the bars, I go through some qualitative observations that we've seen across the industry. The first barrier for some companies have been finding the necessary security clearances for classified intel work that can't be carried out remotely. Secondly, and partially countering that previous point, all companies so far have been able to convert to remote environments with 80% plus workers with virtualized capabilities. Eventually, we think that most of these companies find workarounds to that intel work, whether it be restrictions being lifted in key markets, which has actually occurred on a case-by-case basis over the past few months, or the eventual return to normal operations. So another call out is the CapEx that you'll see in the space is small to really move workers to remote environments, and would really remind people here that most of these companies are concentrated around services and software, and don't really require large capital outlays. So going forward, general trends have been positive with little disruption as proposals have been heavy still. But the biggest impediment so far is related to not being able to collect actual reimbursements for specific work that's already been contracted or completed. Although that net impact has been noticeable, which I'll get into in the next slide, it's been manageable for most peers in this space. So I'm on slide 38 now. So we illustrate the quantitative impacts for COVID-19, starting at revenues. Most of the delays I called out from the previous slide have amounted to a headwind to full year revenue growth of anywhere from 1% to 3%. Which have been absorbed well for most of these companies. Secondly, on the profitability side of the equation, has relation to the revenue impacts and not being able to carry out all work under the contract, which I previously went over, and kind of prompts an inability to invoice for all those fees on some of those contracts. And that amounts to anywhere from a 10 to 100 basis point impact on margins from an EBITDA level. Lastly, when moving down to net income, the total severity of the impact is linked to the reimbursements that I just mentioned. But what we've seen so far is roughly a third of that total impact will likely be recoverable in future periods and doesn't really structurally change their business in the long term. So when you put all of this together, we think this situates these companies well with smaller impacts on their business than most. And they still have good visibility given the current market situation, and still leaves light at the end of the tunnel to restoring prior growth levels at a similar pace to the rest of the market. So on slide 39, the key point is the names year to date through last week and from a 5-year snapshot have been value creators from a short and long-term perspective. So for 2020, this is one of the areas that I think can grow shareholder value through earnings growth and not multiple expansion, which if holds true, inserts some dislocation between the current valuations across the space, which currently trade at a 7% discount, and earnings growth. From here to fiscal 2021, across the space should be about 24%. I think this is more so validated when you look at the snapshot of growth and the discounts of valuations in the market, which really coincides with some of the comments that Colin had in earlier slides. So here on slide 40, we assessed the liquidity and solvency positions across the industry itself. All names, in our view, are well capitalized, so they don't have any near-term financial debt burdens that aren't manageable. Although I think Leidos has a $450 million note coming due in 2020, we expect the company will be able to handle that maturing debt with cash on hand or free cash flow. So on a similar note, we have SAIC, who does have the highest leverage ratio across the space, but we think their available free cash flow will allow them to make the voluntary debt repayments necessary, which we think is in excess of $300 million plus this year, and allows the company to return to historical levels of around 3 times on a net debt to EBITDA level by 2021. So last but not least, we have stock picks on slide 41. First up, we have CACI. To us, remains at the forefront of software-defined work for government agencies. And that's after being caught off guard with, I would say, an overabundance of short cycle work during the last defense budget drawdown. We see CACI as one of the higher quality federal IT services plays that has the competitive cost structure that drives a premium margin profile going forward. The company's pivot to more enduring IT work should translate to an acceleration in revenues and power mid-single, so 7% plus organic growth in fiscal 20 and 2021 with solid margin expansion for both years. So all of this combined, we don't think is reflected in the current valuation, which currently resides around 17.5 times our fiscal 21 EPS estimate. So second, we have FLIR. We upgraded shares to buy from hold following some mixed quarters exiting 2019. We really like FLIR's plan to divest lagging segments, which should help remedy some operational issues that held down organic growth and margins in the past. Furthermore, their exposure to elevated skin temperature cameras, ESTs, remain an attractive growth catalyst in our view. So we suspect that demand could be elevated for the next future quarters as corporations use the product to contain new COVID-19 cases as shelter-in-place restrictions are lifted and offices reopen. So we think shares are now discounting past execution issues, and we like the company with or without the tailwinds from EST. And then last, we have SAIC, who recently reported. We think there is actually upside in the fiscal 21 outlook as they disclosed large recently won recompetes that will not be protested. So that really locks in the most likely case for the company, and with a few more of the right wins could push estimates higher. So overall, at around 14 times our fiscal 21 EPS, we think upside exists and the company deserves to trade closer to peers because of some of these emerging catalysts. So on slide 42, we have a comp sheet if you want to do your own relative analysis. But with that, I think it's timely that we turn it back to Ken for any potential Q&A that we have. Thanks.
Thanks, David, and great insights, Colin and David. We're going to try to get to as many questions as we can over the next 10 minutes. The first question for you, Colin, is you make a strong case of no defense spending cuts. So what is the biggest risk to defense firms in the coming years?
Thanks, Ken. I would say, like you said, we don't think that defense spending cuts are a big risk because we think most of the major defense firms can continue growing earnings through a declining spending environment. But the risks we see are on the operational side. So a good portion of these contracts are structured as fixed fee amounts. So you kind of tell the government what you think it'll cost you to build their missiles or their ships, whatever they might be asking you to do. And in some contracts, you're held to that amount. So we think the risks are on the operational side, where potentially if you get more absenteeism in the workforce, or maybe we get more shutdown scenarios in the fall than we expect, some of those costs that they run up to deal with the pandemic might not be reimbursed. So I would say the operational side, getting costs to stay within their budgeted amounts is a risk. And also something David touched on is just the general environment in defense contracting remains very competitive. So there's always a risk out there that you don't win your next bids coming up in the next few years, and you have to keep winning a fair amount to maintain market share. So there's always that risk out there as well.
So staying on risk, David, what are the major risks for 2021? Particularly, we have a presidential election coming up. There's all kinds of spending influences. What could be the major risk here?
So I think, thanks, Ken, and alluding to kind of Colin's comments here and kind of his first part of his presentation, what I think investors could be missing could be around protest on recompete losses. So it could be contrary to a lot of people's views here, but that's really a big reason why I called out AIC's big recompete win that they had that will not be protested, has a ceiling value of almost $3 billion that kind of future-proofs their revenue outlook for the full year. And just one other good note is over the next couple years, you have roughly 30 to 40% of IT contracts that are up for recompete. And right now, there's a big loophole, in my opinion, where there really are no penalties for other losing companies to come in and protest a deal that they previously lost. So that entire process really buys that company that lost the deal 3 months before they actually had to remove it from financials. So in total, this delays the process for that winning company, the takeaway company, and could push out growth plans by months or even quarters.
David, I'm going to stay with you and talk a little bit about backlogs, since your industry is multi-year contracts, and looking out over the next 12 to 18 months, which stocks are best positioned and why? And backlogs top of mind. Obviously something like Boeing, it's a big deal. So looking at your space, which stocks are best positioned?
Good question. And it's timely because we actually did this analysis in our some previous thematic research. So what we did was actually conducted a burn rate analysis and incorporated future growth rates by keeping backlog flat to really, I would say, determine who's most at risk across the coverage. So as a result, Leidos actually lagged the rest of the group, but that with a burn rate, I think was around 14%. But that was just given absolute revenue levels that they're currently at. But the insights and kind of the takeaways that we had from this is companies that have below average burn rates were companies that were also, in our opinion, more technically versed across the spectrum. So that was your likes of CACI, Booz Allen, and Mantech. But within those three, which all had comparable backlogs, it really came down to their out-year growth levels that kind of separated them from the pack. So the final two were CACI and Booz Allen.
Okay, Colin, you high profile on Lockheed Martin, General Dynamics, and Northrop. Any reason not to mention Raytheon, and what's your investment view on that particular company?
So we do have a buy rating on Raytheon Technologies, and a big piece of that positive outlook is coming from their defense businesses. So they recently merged into the old United Technologies, and the only reason they're not called out in this presentation is because they're now a roughly 50-50 split between defense businesses and commercial businesses, somewhere in that range. So we do really like the defense side of the business, and we think it's a pretty good growth, pretty good story long term, because we think the impact of the COVID-19 pandemic on the commercial aerospace side was probably a little over exaggerated, but just the simple answer is they're not a pure play defense company anymore, like they the previous Raytheon used to be. So they just weren't included in this presentation.
Got it. And I'm staying with you, Colin. You had one slide speaking to defense spending, 60%, I believe personnel operations, 35% plus, procurement, equipment, R&D. So this question came in saying President Trump looks to be pulling troops and maybe resources out of Europe and the Middle East. So how does this affect your companies?
So I think that's a great point, and I actually think it kind of reinforces our thesis here. So if let's say that those pullbacks in the Europe and potentially the Middle East, they do come through in a big way, that is going to be flowing through on that personnel and operations side, in my opinion. So where the defense contractors are generating their revenue and where their backlog is, it's really a vast majority in procurement and R&D. So if you pull troops out of Germany, for instance, we don't think that's going to really impact the procurement and R&D contracts. And also, just if you think about the scale of some of those troop drawdowns, compared to where we were, in 2010 and 2011 after some surge operations in Iraq, the type of troop drawdowns we're talking about today in Europe or the Middle East, I really don't think they would move the needle in any way close to the same way as the previous drawdown periods we highlight, such as 2012, 2015, and also mid-90s, those type of major operation drawdowns.
David, one last one for you. For federal IT services, contracts are getting bigger and lumpier. Why is that? And I'm going to throw into this, if the big battle between Amazon and Microsoft on the cloud, that was multi-billion-dollar contract. So maybe you can thread both of these questions.
Sure, and they do coincide, and that's a good segue into both parts of the question. So it alludes really to the technical expertise and portion that I was referring to with the presentation. Companies that have really made the proper adjustments with that software first approach likely win. And contracts that become more complex, they can't really be broken up into multiple layers like they have been before, which alludes to the JEDI contract that you're referring to, Ken. And the work requires more development and operations, or DevOps, and further relies on some of the technical skills from each company. I would mention that most of these companies do work hand in hand with the likes of your Amazons or Googles of the world. But in most cases, this kind of work, and the reason why more of these companies are going after this and why it's more important is A, because there's not as many to go around because they are bigger and lumpier, and B, it leads to more profitable contracts that as they get worked into the backlog and released to revenues, it translates to higher margins for each company. So hopefully that answers the question, but they do go hand in hand.
Great. And I'm going to take the last question. So midway through the session, we had a question as how can you play some of these top companies in terms of investing in ETFs? And I actually did this. So on Market Scope Advisor, you can go to the ETF tab at the top, go to the ETF screener. And the answer to the question is we have 3 outstanding ETFs to play defense and aerospace. They're all rated 5 stars. The first one is Invesco Aerospace and Defense, ticker is PPA. The next one is the Spider S&P Aerospace and Defense ETF, ticker XAR. And the last one is the iShares, US Aerospace and Defense, ticker is ITA. All that can be get on Market Scope Advisor. Kessie, let's move to slide 44. Well, we had a fascinating webinar today on areas that are not correlated to the US economy and have great secular trends. Upcoming next webinars, June 25th, Consumer Staples and the Future of Meat Production. It's both the problems of meat processors and the emerging growth in IPOs coming for plant-based and land-based meat alternatives. And then we have our classic 2020 mid-year review and outlook, benefiting from the BTE, better than expected bounce, led by Sam Stover, our Chief Investment Strategist. To get more information either on these upcoming webinars or our research, take a look at the bottom here at both of our web addresses for webinars, and of course, advisor.marketscope.com. So with that, we hope this was a rewarding webinar for you. I want to thank our presenters, Colin and David, and most important, stay safe and healthy out there. Thank you again.